have to go before 11.
Yeah. Okay.
And get ready. You can start.
Yeah.
Yes.
So
so events after the reporting period.
Yeah.
Oh, okay.
So we are looking at IAS2, which is inventory. Yeah. And first, maybe we need to look at the objectives. What are the objectives? What's the objective of this particular lesson? By the time we are done, we should be able to determine, or you should be able to determine the initial measurement of inventory assets. We know that inventory assets are those that are usually consumed or used within within a year. Hello, I can't get you.
Okay, sorry, go on. Okay, yeah, the line was breaking. Let me check my net. I was wondering whether it's my side. Okay, I think I'm okay. Go on. Yes.
Okay, sure. So that will be the first thing that we need to do by the time we are done here. You should be able to determine the initial measurement of inventory assets. How do we measure inventory? Yeah. Understand the cost formulas that are permitted by IAS2, which is basically the standard that guides how we should account for inventory. 3, we should be able to calculate the appropriate carrying amount of inventory at the reporting date. 4, test inventories for impairment because they can actually go obsolete. So we should be able to test inventories for impairment by applying the lower of cost or net realizable value calculation to ending inventory, meaning that any of the two which is actually lower, that is what we pick. Is it the cost or the net realizable value? So any of the two, that is what we're going to actually pick and value this particular inventory. The difference then comes in as impairment. Determine the appropriate measurement of cost of sales for a reporting period. Just before we met, I was actually helping someone is in Botswana. He's doing an analysis on how the company is performing. So in the first year, the gross profit margin sorry about that. My internet misbehaved.
Okay, so yeah. So you keep cutting.
Yeah, my internet is not stable. But are you able to get me?
So you were. Yes, now I can hear you, but it cut off when you said someone from Botswana. Then
yeah, he was actually doing an analysis. So he wanted to be helped. In the previous period, I think the gross profit margin was lower than in the current period. Then the net profit margin in the current period was lower than in the previous period. So I was actually telling him that what has caused that indirect costs, which were much higher than in the previous period. And these indirect costs, the organization needs to find ways of actually cutting them or reducing. Otherwise, if the gross profit margin is much, much higher, at least you should actually draw some comfort that the direct costs, those costs that are actually helping you to produce these particular products and sell and eventually sell them, they are actually within the limit that is acceptable. So I was just trying to giving that because you see under gross profit, that is why you find your inventory, because your inventory is under cost of sales. So your gross profit margin is a product of that.
So the net, so the gross profit is higher this year, but the previous year it was lower.
Yes.
The net profit is higher this year, but lower, but it's lower this year because of the indirect costs.
The indirect costs, these are costs that are incurred after you've produced your product. Yeah.
That's
Maybe
yes.
admin costs, marketing costs. So those are costs that they can actually find ways of reducing them or fully analyzing them and see their relevance. Because again, you don't just reduce costs because they are indirect costs. You could find that maybe those costs are costs that are strategic. There's some thinking behind it, that maybe you want to spend a bit on marketing so that you bring in a lot of visibility in the near future. So dividends can only start showing in the next few years. So if you try to reduce or cut them, you might actually be cutting the possibility of earning more revenues in the future.
Okay, yes. Okay.
Okay. Fair play?
Okay. Yes, that makes sense. That's good. But the screen is blank. It's just black.
It shows that it's either your internet. Okay, now you're able to see it's flooded.
Yes.
Okay. So what comprises of the inventory, of the cost of inventory? There are about three here. It's the cost of purchases, cost of purchase. So you buy this particular product, maybe it's milk. The cost of buying this milk will be part of the cost of inventory. But your business is to actually produce cheese. So along the way, this particular milk has to be kept for some time as part of the process. So there will be cost of conversion. So whatever costs that are incurred in actually changing this particular product into cheese, those costs of conversion will be part of the inventory. And other costs incurred in bringing the inventory to their present location and condition. You got this milk from some farmers on the west side of London, and you have to drive to your place, to your facility, maybe it's 20 or 30 Ks. Whatever cost that you're going to incur will be part of that particular cost of inventory. Yeah. I did mention already on the cost of purchase. Conversion costs, the cost of conversion of inventory include costs directly related to units of production, such as direct labor, to include the systematic allocation of production overheads. So those become part of the inventory costs.
Okay.
So what is excluded? In life, you don't just learn about what must actually make up that particular cost of inventory or anything in life. You also need to learn the things that you're not supposed to do. So we have exclusions here. Abnormal amounts of wasted materials. Yeah, so this cost will actually not be part of the inventory cost. The abnormal cost, I'm sure you should remember in costing, there used to be abnormal loss, normal loss, abnormal gain.
Loss, yeah.
So anything abnormal, anything abnormal, you cannot actually factor it as part of the costing of this inventory. What it means then is that there were some excesses that you could have actually managed to control, but you didn't. So it's on you. It should not be part of the cost of inventory.
I was just going to say a place where I'm going to start. Will be interesting, because they build houses. So their stock will be made up of all sorts of materials, isn't it?
Yes.
To bring up that home or whatever it is.
Yeah, but even, for example, they actually spend due to poor workmanship. They get people who are not experienced and they start cutting things that are not supposed to be cut in that manner. And there is total wastage. You cannot actually get the cost on wastage and put it as part of the inventory. That would be very unfair. That is poor workmanship. So that is what we are saying, that any abnormal amounts of wasted materials must not be part of the cost of inventory.
Okay.
And it shouldn't be anyway. Storage costs. unless those costs are necessary in the production process before a further production stage. Like I did mention on cheese, we know that for you to actually produce cheese, there must be a process, and that process involves storing, so that it's part of the process. So any costs that are incurred in that manner, those become part of the cost of inventory. Otherwise, if it is not meant for that, if the process of producing this particular product does not allow you to store, or you are not supposed to store, you store because you have had your own other issues.
So if you've stored your milk, like you're saying that storage cost is not part of the inventory.
No, but if you are storing because it's a process of you producing cheese, that becomes part of the cost of inventory. But in this case, where it is not part of the production process, then whatever cost you're going to incur, it should not be absorbed into your inventory.
Oh, it's okay.
You get it?
Yes.
Do you? You don't seem to.
I think I do. Now, I was just trying to picture, I was just thinking of the milk example. So, for instance, maybe if you're going to store that, you've used up your milk, you've gone through your production process, and you've got leftover milk, maybe that you're going to either try and sell off or give away, but wherever you're going to store that cost will not be part of the inventory, right?
Yes.
For example.
Yes.
So do I it's
Yeah. Now I can see you have gotten it. That's a good one. Then administrative overheads.
Okay.
Administrative overheads that do not contribute to bringing inventories to their present location and condition, those should be regarded as a cost that must not be factored into your inventory. Yes, the administrative costs, but they are not helping you in bringing this particular product location and in good condition. So any administrative overheads, those should actually be excluded. The selling costs, you have this product, and whatever cost that you're going to incur on selling the product, that should not be part of the inventory cost. It doesn't just make sense anyway. Borrowing costs, except that inventory is requiring a substantial period of time to make ready for the intended sale or use may qualify for capitalization of borrowing costs. When you borrow for a project, there will be two types of costs. That interest that you pay your lenders may be divided into two forms. There will be component of interest that will actually be capitalized, meaning that that component of interest shall be part of the costing of that particular product or inventory. Then there will be interest.
Okay, when do you capture?
Yes, very good, very good question. There's what we call in our industry. You hear now I'm busting, eh? In our industry,
I know.
There's what we call IDC, interest during construction. So any interest that is incurred during construction, that must be capitalized and it must be part of the costing of your product. After the product has
during
been
construction,
yes.
Construct, then the interest after that you cannot capitalize.
Yes, because you see the interest after that, it's logical. Again, it takes you to a very basic concept in accounting, which is called the matching or accruals concept. And it states that any revenue earned must be matched against expenses incurred in earning it. So during operations, you are generating revenue, you are also incurring costs, and that interest is also part of the cost that is being incurred as you generate this revenue. So it must be matched, the revenues up there must be matched against the expenses incurred in earning it. So you cannot capitalize, you cannot actually include it as part of the costing of your product. You wouldn't and you shouldn't. Mandela.
Nambela. Okay.
Thank you. Thank you.
Thanks.
So on the inventory cost formulas, specific identification of inventory cost means that specific costs associated with certain identified items of inventory that will be specified. So inventory accounted for under the specific identification approach are not ordinarily interchangeable. Inventories that meet the criteria for this approach must be accounted for under specific identification. Alternatives are not allowed. Here, you're just looking at specific identification of inventory costs. So they have to be very specific. We should be able to identify them.
Identified item.
Because you are costing them. Because you are costing them. So you don't want to start looking at the weighted average, FIFO, LIFO, and the like, because these costs are direct. You are able to identify them. So if you are able to identify them to specific areas, then it becomes easier for you to actually cost that product. But where you have challenges, that is where now you have to start thinking of using FIFO or weighted average. Others may use LIFO. So if the inventory do not meet the requirements of the specific identification method, then you should assign costs using a first in, first out method or weighted average cost formula. But the consistency is that once you use the FIFO, you should continue with it. Not midstream or after a year or so, you decide to go to LIFO, you decide to go to weighted average. You should be at least consistent. Though I've been told that the people that are always right in life are those that actually are inconsistent, because they change their views based on the inputs they're actually getting. I'm not saying you should be. I'm not saying you should be inconsistent, but I'm told those are the people that are right. Usually right.
That are what?
That are usually right.
Really, people
who are actually inconsistent. Yeah, because they make decisions based on the inputs that they are getting. So they will not actually stick to something because it's wrong, and they stick to it.
Oh, okay, yeah.
So the moment they get something, they'll change. This is why even in life, you find the people are able to apologize when they notice that they have created a problem or injured someone based on the assumption that they actually used. Then they are generally good people. Then people die with it.
Yeah.
Yeah.
Even when you know that no is wrong.
Yeah, and you stick to it. But if you have new inputs, data, which actually shows that possibly what you thought is not correct, then you have to change. You've been consistent, yes, but you're inconsistent based on the available inputs that you're using to generate these particular decisions. Fair play?
Yes, very fair.
Okay. So net realizable value. This is how you compute your net realizable value.
It hasn't changed the
price of the product. Oh, it hasn't?
Oh, it has now.
Very good. So on the net realizable value, I think we looked at this at some point. Is the selling price. You have this phone that you want to sell. How much do you want to sell it? You want to sell it at 50 pounds. Then you have to reduce or subtract any cost to go to completion. So you subtract those costs. You also subtract the selling costs, any cost that will be incurred as you sell this particular product. So what you're going to have will be your NRV, which is a net realizable value. What are the frequently asked questions on NRVs? Determination without a price. 1. How do I determine NRV if I don't have a firm sales price? So we are saying, even if you do not have a firm sales price, please, you are required to determine or to estimate the NRV. This is maybe based on the most reliable evidence available at the time.
Okay.
Maybe a similar product at whatever price is actually being sold. You can use those inputs in coming up with a decision. But in any case, you have to estimate the NRV. Events after the balance sheet date. The question would be, should I consider events that occur after the balance sheet date? So I'll answer what you're saying. Your estimate of NRV, the net realizable value, should take into consideration fluctuations in price. Should take into consideration fluctuations in price or cost directly relating to events occurring after the end of the period. So after the end of the period, those variations must be actually taken into consideration, but only to the extent that these events confirm conditions that existed at the balance sheet date. I think we must have actually looked at this when we are looking at, is it IAS10?
Yes, IAS10, events after the period.
Very good. You are very brilliant.
I think.
Yeah.
I need to study and start practicing more questions. Otherwise, I don't want to disappoint you.
You shouldn't. Yeah. So examples of post-year-end sales prices declined because of damages to the inventory. We looked at these almost similar examples under IAS10. This would confirm conditions that existed after the balance sheet date. This would not be considered in determining NRV year-end. So you have to look at all these things.
Okay.
So example, suppose a competitor introduces a superior alternative product before the year-end date, and this new product is cheaper and more efficient. Sales prices will decline in the subsequent year because of that, obviously. This situation would confirm the existence of a balance debt condition leading to a price decline. Therefore, it has to be factored under the NRV.
Okay.
So they have introduced a much, much superior product than you have. And they saw prices in the subsequent years, they start actually declining or eroding.
Oh, yeah.
So it confirms that even before the year end, there were such signs, this condition was prevailing. Just that it had not yet exploded.
Oh, yeah.
Different contractual sales price. Question: what if I have a contractual sales price that is different from current market?
Oh, yeah, because you've signed estimates.
So we're saying the estimates of NRV should take into consideration the specific purpose for which the inventory is held. If you have a contracted price for items of inventory, you should use those contracted prices, even if general selling prices are different, because those are contracted prices. How do you move out from or move away from your contracted prices?
Okay.
That's binding, isn't it? Legally.
Oh, yeah.
Sure. inventory values if circumstances change. Question. What if circumstances change and NRV increases? Can I write up inventory values?
Write down.
So write-downs to NRV may be reversed when the circumstances that previously caused inventory to be written down below cost no longer exist, so you can change that. Or when there's clear evidence of an increase in NRV because of the changed economic circumstances, the amount of the reversal is limited to the original amount previously recognized as an expense. Always limited to that. You cannot go beyond.
Oh.
Because what you are reversing, it has a ceiling, so you can't go beyond. You get it?
Yes. Oh.
Keep it on. Thank you so much. I can stop
Palumba.
recording.
Is that right?
Dalumba kapati.
Kapati.
In ila we say Dalumba maningi.
Oh, yeah, Dalumba maningi.
But in Tonga they say Dalumba kapati.
Oh, Dalumba maningi. Yeah.
Lumba.
Ingi. Ingi. I'm just